Okay, is it me or you?
I'll let you take the lead today, man.
Okay, okay. So, some have said I'm old, jaded, and insensitive. So, I guess we'll start with that, right?
It's
Because,
Mental Health Awareness Month, Mike.
yeah, that's where we're going.
Most appropriately so.
Yeah, exactly. Yeah, and many have comments to make about my personal mental health, but that's an entire separate episode. So anyway, why did the debt ceiling continue to seek therapy?
Oh boy, why?
Because it can't find its boundaries.
Ah.
So I hope
Oh.
that wasn't old, jaded, and insensitive
No,
to.
man.
Yeah.
Most appropriate though.
Okay.
Welcome. This is the real estate and economy this week. A new subsegment of the Move It podcast here. My name is Jared Uraine.
Hmm.
Miguel Francis,
Yeah.
our guest host today, and actually this new chapter, this new series, this particular segment is really designed for addressing the real estate market update as well as the economy in an expanded format. It turned out to be such a success that we are going to add it to the podcast, but in its own cycle. So, if you are looking for information on the current situation as to what's happening in the economy, don't listen to the media hype. You can just listen to it here with us old, jaded, and
Insensitive.
insensitive
Yeah.
folks
Yeah.
here.
Just ask my kids, but yeah.
All right. So this is real estate and the economy this week. My name is Jared. This is Mike. Let's get started. And welcome back to Real Estate and the Economy this week. My name is Jared with my friend Mike. Mike, we have three topics we're going to cover today: the debt ceiling,
But
inflation, and the jobs report, right?
right, and with the debt ceiling, I always enjoyed Albert Einstein. I love his quotes. One of my favorite quotes of Albert Einstein was, when they presented him with the Big Bang Theory, he said that God did not play dice with the universe. I like that one. But regarded to the debt ceiling, he also said that the universe is, oh no, how did he put it? He said that the universe and mankind's stupidity is unlimited, and I'm not sure about the universe. Yeah, yeah.
Right?
Yeah, yeah.
Yeah. And so, for those who are just joining us, this is Real Estate and the Economy this week. And this is going to be an expanded format of the news and updates that are related to those subjects with our armchair economist, aka Miguel Francis. Mike, before we get started, can you just give us a little background on your, your resume and how you got here, man?
Okay. Yeah, well, before I went blind, which was about 15 years ago, I was working at J.P. Morgan, financial consultant, and I was a bank officer and all of that. And I went blind. That's what ended my time with J.P. Morgan. I very much enjoyed working there. And prior to that, I was the founder and CEO of eMortgage Corporation. And prior to that, I also had Land Inc. But anyway, I was the CEO and founder of North Star Insurance and Investments. I sat on the health advisory board to the division of insurance and a couple of volunteer groups.
Yeah. And you and I have been personal friends for 14, 15 years.
It'll be 15 years come August, yeah.
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 And ever since we've known each other, I think in the last couple of years we've really kind of, because of a lot of the things that have been happening in not just the United States but really the world. Sometimes we elaborate, we go do deep dives into these analyses,
Yeah.
and so it just seems appropriate that we do this on camera because I feel like the information, the content, how you process things has value, and I feel like you're able to compress it to a simplified format that gives anybody the ability to understand such really like kind of complex issues that we're dealing with right now. So with our current state of the economy, The debt ceiling, of course, is the hot topic.
Right.
Give us a little background on what that is and why people need to be aware of that.
Okay. Well, Will Rogers defined it real well. He said it's like a submarine that's got a leak. You put a Band-Aid on it, but you're still underwater. Anyway, the debt ceiling is basically the United States, debt, how much they can spend, and they've exceeded it, and it's happened over 100 times in the, since, in the last 100 years. But they always successfully navigate it. But right now, what's happening is they're struggling, and they're coming up to the deadline of the debt ceiling, and they're struggling to make a decision. And it's a pretty complicated decision. But one way to illustrate it for our listeners, imagine in your household, you and your spouse have maxed out your credit card. So you guys got expenses to pay. You got food to buy. You got to keep the lights on. You got to pay the rent or mortgage. So the suggestion comes up, well, we've maxed out our credit card. All we need to do is get another credit card. And that's kind of the argument with the debt ceiling.
It's interesting.
Yeah.
I've tried that technique, except I wasn't maxed.
Just getting another one, yeah.
Just getting another one to raise to adjust the ratios at least.
Yeah.
But the U.S. economy and its debt ceiling, I mean, it's a little more complicated than just a household debt limit.
Yeah.
Right?
Well, that's because financially speaking, the United States are the parents and the rest of us are the children. So when the United States government can't make up their mind, it's the children, the rest of the population on the planet that are going to suffer. It's pretty serious consequences.
Yes. So the reason why this conversation about the debt ceiling is important because, well, for 100 years it's just been raised so that we can accommodate the budget. But because there has been no instance to reflect on as to when the United States might have defaulted on that, what would be the impact potentially if the U.S. did not deal with the debt ceiling limit and allowed the budget to default?
Well, there would be quite a few different things that could happen. Financial markets would be in complete turmoil. There would be a free fall. What makes the United States financial markets successful is their rule of law and their transparency, and more importantly, their consistency. Their consistency. And the minute that's given up, that's going to throw the entire planet into a financial tailspin. It's a remarkable concern.
You said consistency, and the first thing that came to mind was the full faith and credit of the United States of America.
Which brings us to the other issue. Let's say they push the debt ceiling all the way to the edge. Well, they've done that before in 2011 and in 2013. In 2011, as we mentioned last time we spoke, it caused the Standard & Poor's to downgrade the creditworthiness of the United States to AA, down from AAA.
Tarnished.
The consequence, well, that's a good way of putting it. So if my credit is below 650, I'm going to pay a whole lot of different set of interest rates than if my credit's above a FICO score of 750.
Or 800.
Well, yeah, 800 is where you need to be. So anyway, that's the United States. Their credit was downgraded in 2011. They didn't, go past the X date. They didn't default. They simply came too close to the X date, and they got downgraded. So as a result, the United States has had to pay higher interest rates ever since. Coming up again, if they get too close to the X date, or that would be the date that the federal government can no longer pay its bills, then that's the risk they take.
It seems like we're about 3 weeks out from the end of the month. Why is June 1st identified as the X date?
Well, Janet Yellen of the Treasury Department, she's the one who keeps track of the United States checkbook, so to speak. And the cash flow going out, there will be no money left in the bank account for the United States, and they won't be able to pay their bills. Now, the reason that that's happening is, number one, the debt ceiling has not been increased, but number two, there was a weaker than expected tax return receipts on April 15th, and that was in part due to the fact that places that were suffering from catastrophes such as California, global events,
Right.
they have had, like California, they don't have to do their taxes till April 15th. So California hasn't submitted their taxes yet. That's had a huge impact on the Treasury receiving money. And the tax returns they did get were disappointing. The hope was that we would make it to June 15th because we get another 150 some billion from corporate taxes at that time, hopefully in an expected way. But the concern is we won't make it that far. Just won't have enough money in the bank, in the Federal Reserve.
Who makes the decision on raising that debt limit? Okay, without getting political.
Yeah, right. Congress in the United States, well, Congress has to approve it and the president would sign off on it. But that takes us kind of into another murky discussion, which could bring, throw in, why not have a debt ceiling crisis? Let's have a constitutional crisis. Yeah, the idea, let's say Congress doesn't approve it because they don't want to, I guess, then the president could invoke the 14th Amendment. The 14th Amendment says the United States has to pay its obligations. However, that's never been invoked, and there's arguments on both sides whether or not that's even legal. Even though it's in the Constitution, it may or may not be legal. So who decides? I don't know.
Yeah. So the reason why this is a hot topic at the moment is because of the potential challenge that Congress has in finding a unified answer in raising that ceiling, mainly because of the polarization that's going on in there.
Well, they have a challenge in finding a unified answer on anything.
Well, that's just another day for them.
Yeah.
But the polarization of Republicans as well as trying to get the agreement from Democrat side likely will have some issues to go through. But that's the concern coming from the higher ups.
Well, for the market, it's just a matter of math that if we have a downgrade of a creditworthiness, the United States is going to pay quite a bit more interest. And so it's likely that Congress or the government will not make a move until the market starts showing red across the board and it's affecting the constituents' 401ks. When people who are the constituents of these leaders start losing money in their retirement accounts, that'll be the catalyst possibly that'll move those in Washington that are responsible to make a decision.
To make that move.
Yeah.
So at the moment, the Federal Reserve is dealing and trying to navigate all of the banking crisis along with this debt limit, and at the same time trying to tamper down inflation.
Yeah, inflation's a different animal. CPI and PPI numbers come out in the next couple of days, and inflation, unfortunately, the market is expecting it to be the same as last month, 5%. It's kind of interesting. Food has gone up, dining out has gone up, fuel has gone up because of production restriction by OPEC, and those are things that nobody can really control. You know what's interesting? The unemployment report came out on Friday at 3.4, which goes all the way back to 1969, and the pre-pandemic rates. They added 253,000 jobs when the market was anticipating 180,000. So that caught a lot of people by surprise to have such a strong unemployment rate. But there was an additional good news is bad news sort of thing. People working, that's a good thing, right?
Right.
But it creates a hotter economy and that pushes inflation. Well, there was more good news, bad news. People are getting higher raises than hoped for. They're getting like increase in wages of like 4.6%.
Wow.
And that's higher.
And that's a good thing for them. That's why it's a good thing. But
for that person.
If the Fed is trying to tamper down the inflation, is contradictory to that, right?
Right. When that person is getting increased wages of 4.4%, that forces that employer to absorb those higher costs. that employer, he has a particular margin he has to meet if he wants to stay in business. So he's forced mathematically, financially, to pass that on to the consumers. Inflation, you know.
Yes. And so it's not that us jaded old guys, people out of
old,
work,
jaded, insensitive people,
that the fact is typically the correlation is higher unemployment will allow inflation to cool down because these folks are not spending money and going.
Well, ideally, the market unemployment rate should be a little bit north of 4. 4.5 is actually pretty good, but that would be 2 million plus people would have to lose their jobs. And that's not going to happen right now. As we've stated previously, we won't know the exact numbers until tomorrow, but the unemployment last time, there's 1.655 jobs for everybody that's looking. There's not enough people searching for jobs. Historically, that number should be a whole lot closer to 1.1, somewhere in that neighborhood. So that's an incredibly high number, and people are struggling to find persons to even put in their business.
That is correct.
Yeah.
That's correct. In fact, so I'm going to throw a theory out there.
Okay.
We didn't talk about this beforehand, but
I love it. I like the live stuff. Yeah.
Cold turkey here.
Let's go for it.
What if 3 million people, or 4 million people for that matter, unanimously agreed to say, I choose to not spend X number, like 50% of my income, I'm just going to hold and adapt as if I was living paycheck or no paycheck, Would that have, if you had 3 million unified people like just doing that, would that have a correlation to the impact that would help?
What's the population of the United States? 330 some million? Yeah, so you're talking 1%? Not really. Plus, the people that would agree to do that, they probably aren't the segment that's spending the most money in the market. Those are people that are inclined to save money anyway.
So then, if the unemployment rate goes to 4%, and that's equivalent to what, 2 million, 3 million people?
Well, it'd have to 4.5% would be 2+ million people. Yeah.
Okay. So why wouldn't that have an equal correlation?
Oh, that would. But why wouldn't it have? Because the people agreeing? Is that your question?
Right.
Because the people that would make such an agreement, they're inclined to not spend and save money anyway. My wife would be leading the pack in that group. You kidding me? So yeah, she doesn't like spending money. She's the only person I can give my wife a credit card, say, baby, buy whatever you want. She's mortified if she spent $79. So the people in that agreement, in this fantasy world, would be persons, that would be inclined to save money anyway. And that's not who we're targeting to make this decision.
But it's not just people not spending money. It's the employers who have to employ them as well. There are additional fees and costs that help contribute to that number overall in terms of inflation, right?
Yeah, it's a fairly, the world is a fairly complicated, entangled place, and many of those employers, are represented on the stock market, and they have earnings they have to report quarterly, and they're competing against other companies for equity positions, etc. And so those employers are going to maintain their margins. They're not going to give up profits, And those same employers have to hire quality employees. Employees right now are moving from job to job faster than they ever have, because they're dumping employer A to employer B because maybe employer A gave them a 4.4% raise, but employer B is going to hire them for 7.6% more. That's a jump of over 2%, so they make the move. That's another problem with the employment market right now. The average time a person is staying on the job, especially for those under the age of 35, is dramatically reduced.
Yeah.
Yeah.
Well, that really helps break things down for us, Mike.
Yeah.
We literally went through all 3 segments.
Clear as mud, right? Yeah.
You said you were on the way in thinking about writing a book.
Oh, yeah. Well, my granddaughter, she's in the 1st grade. And I'm heavily into education or self-education. You know, I definitely think that everybody should read or listen to podcasts. I highly recommend it. As a matter of fact, if you're an entrepreneur, I recommend How to Win Friends and Influence People. But I want to write a book for first graders, you know. And so I get to plug my book. Is that what you're saying?
Yeah, sure.
Right on. So the concept of this book is a small village in a beautiful little valley, right? And there's a few villagers, but there's two key people in this village. There's a farmer and a baker. The farmer produces wheat and the baker bakes bread. So they make an agreement. The farmer's going to give the wheat to the baker will make the bread, and they'll sell it to the villagers. Now the villagers, they have to buy their bread a year in advance, right? Because they all work for the farmer, they only get paid once a year. So each year when the villagers purchase their bread, they have to buy it on credit. Well, the farmer and the baker agreed on the credit limit of the villagers. Well, this works great, and people move in from all over because the bread's fantastic, everybody's happy. Well, the village grows faster and faster and faster, and pretty soon a time comes when the village is so big, the villagers exceed. They have bought more bread with their credit than the farmer and the baker agreed to. So then the farmer and baker bicker. They don't agree on raising the credit limit of the villagers. So the villagers are no longer able to buy bread. They start eating their shoes for food. They exit the village, and the village is gone. And the farmer and the baker have gone out of business, and the village is no more. Happily ever after. The end. So that's the children's book I want to put out.
Hey, that's positive.
I think, yeah, absolutely, yeah. Children need to be educated on debt ceiling limits and things like that.
You know what? With some of this AI tool, I think we can whip that together pretty quick.
Yeah,
man.
that's right.
I think we're going to do that, man.
Yeah.
Mike, thanks so much for joining us, man. Do you
Right
have anything else to add before we wrap it up?
Keep your eye on CPI, tomorrow on PPI, and just hang in there. Stay informed and self-educate yourself if you have the opportunity. And if anybody wants to reach out to me, they can on LinkedIn.
Yes.
Michael Anthony Francis, Armchair Economist.
Yes, and we have your link in the description of this video. So
Great.
If you want to get access to that and connect with Mike through LinkedIn, feel free to follow that link. Well, that does it for this episode of Real Estate and the Economy this week with me, Jared, and the armchair economist himself, Miguel Francis.
Right on.
Thanks for joining us, my friend.
Had a good time.
That does it. Have a great day.